Gold is set to open $200 higher. Not $20, not $50, $200. In a single session open, take a moment with that number, because if you have been following gold for any length of time, you understand how extraordinary that is. Gold does not move $200 at the open. It does not gap up by that amount between Friday's close and Monday's bell under normal conditions. That kind of move does not happen because of a data release or a Fed statement or a currency fluctuation. It happens when something fundamental changes over a weekend. When events occur between Friday afternoon and Monday morning that force institutional money, the pension funds, the sovereign wealth funds, the central bank reserve managers, the serious long-term allocators, to reprice the entire risk environment before the market even opens. That is what happened this weekend. And while the $200 opening gap in gold is the most dramatic single number from this week is developments, it is not the only signal worth understanding. Oil is up between 4 and 7% on supply disruption fears. The dollar strengthened as a safe haven. Global stocks declined sharply. Treasury yields fell as bond demand surged. Every major asset class moved simultaneously and in the same direction. This is not a normal market day. This is a market making a collective judgment about a world that looks meaningfully different than it did 72 hours ago. And if you own any of these assets, gold, silver, oil, stocks, dollars, bonds, you need to understand exactly what that judgment is and what it implies for where things go from here. We are going to work through this carefully, with the facts as they are, without exaggeration, without speculation dressed up as analysis, just the data, the logic, and the honest assessment of what a $200 gold gap at the open actually means. Let's establish the facts in sequence, because the sequence matters here. Over the weekend, U.S. and Israeli strikes on Iran escalated significantly in scale. The strikes resulted in the death of Iran's supreme leader and 40 top officials. That is not a routine military action. That is a leadership decapitation event, the kind of event that immediately raises fundamental questions about what comes next, about succession, about institutional stability within Iran, about who controls the retaliation decision, and what form that retaliation takes. Iran responded. Missile strikes targeted U.S. Gulf assets. Explosions were reported in Bahrain, Dubai, and near the Kuwait embassy. Hezbollah struck Israeli sites. 3 U.S. service members were killed. 9 people were killed in an Israeli city strike. President Trump stated publicly that the conflict could last 4 more weeks until U.S. objectives are met. That statement deserves careful attention. It is not a statement of uncertainty about the timeline. It is a stated expectation of at least 4 more weeks of active engagement. That is the U.S. administration telling financial markets directly that this is not a 48-hour situation. This is an extended conflict scenario. The analysts who described weekend events as catching markets off guard in scale are correct. The scale of the strikes, the scale of the retaliation, the level of casualties on multiple sides, the geographic spread of the explosions, from Bahrain to Dubai to Kuwait, all of this exceeded what the market had priced into Friday's close. And oil markets are now watching something that every energy analyst has been worried about for years, the Strait of Hormuz question. Whether the conflict escalates to the point where that critical waterway is threatened. Oil at a potential $100 per barrel is being discussed. That is not a fringe forecast. That is a legitimate scenario being modeled by serious market participants. That is the factual picture. Now let's look at what it did to every major market simultaneously. Let's go through each market one by one, because understanding each individual response and then seeing how they fit together is where the real analytical value lives. Gold. Gold climbed over 1% in early trading and is set to open $200 higher. Those two numbers, 1% in session and $200 at open, sound contradictory until you understand the timing. The 1% move reflects trading that occurred during market hours and sessions that were already open. The $200 gap reflects the full weekend repricing that had accumulated before any market opened. The $200 number is the more significant one. It represents the verdict of every institutional investor who looked at what happened over the weekend and decided, before a single trade was placed, that gold needed to be priced at a fundamentally different level than where Friday's close left it. Silver followed gold, as it typically does in a genuine risk-off environments. The monetary case for silver strengthens alongside gold when geopolitical risk surges. The industrial case faces uncertainty from the economic disruption risk of a prolonged conflict. But in the immediate phase of a geopolitical shock, the monetary response dominates. Silver moves with gold, and that is what happened here. Oil. Oil is up between 4 and 7%, with the potential for $100 per barrel being discussed. That range, 4 to 7% in a single session, is a significant move for an asset, as large and liquid as global oil. And the $100 discussion is not hyperventilation. It is what happens when you take the baseline oil price and add a realistic supply disruption scenario involving one of the world's major producing regions and the waterway through which a substantial portion of global oil flows. The dollar. The dollar strengthened and the dollar index was volatile. This is the most complicated response of the week to explain. The dollar is behaving in a way that seems internally contradictory, strengthening as a safe haven while also facing the fiscal pressure of military engagement. The short-term safe haven demand is winning over the medium-term fiscal concern in the immediate aftermath of the events, but the dollar index described as volatile tells you that this resolution is not settled. There are competing forces pulling the dollar in different directions simultaneously, and the market has not yet fully resolved which force is stronger. Stocks. Global stocks declined sharply. Equities are facing exactly the kind of environment they handle worst. Genuine uncertainty about the near-term future combined with a specific and credible threat to energy prices and global trade flows. Stocks priced at elevated multiples based on expectations of continued economic growth do not perform well when oil is surging toward $100 and a major conflict is expected to last at least 4 more weeks. Treasury yields. Yields declined as treasuries saw inflows. Bond buyers are accepting lower returns in exchange for the safety of U.S. government paper. This is the standard flight to quality response. And yields falling alongside gold rising simultaneously is one of the clearest signals of a genuine risk-off environment. When both of those things happen at the same time, it means institutional money is not just buying gold and walking away from bonds. It is buying everything that offers protection and walking away from everything that requires confidence in the near-term economic outlook. Every single one of these moves is internally consistent. Every single one of them points in the same direction. This is not a confused or contradictory market response. This is a coherent institutional judgment being expressed across 6 different asset classes simultaneously. Most of what gets called gold analysis in the financial media is commentary on incremental price moves. Gold up $15, gold down $8, gold reaches a new weekly high. That kind of coverage treats the gold price as a continuous stream of small adjustments driven by the ebb and flow of daily news. A $200 gap at the open is categorically different. It is not an incremental adjustment, it is a step change. It is the market saying the old price was wrong. And here's the new price, and there's no path back to the old price through normal trading. Because the world that justified the old price no longer exists. To understand why that matters, you need to understand how institutional money actually works. Large allocators, pension funds, sovereign wealth funds, central bank reserve managers do not sit in front of screens watching tick-by-tick price action and adjusting their positions continuously. They make periodic allocation decisions based on their assessment of the risk environment. And when the risk environment changes fundamentally, they adjust those allocations. But they adjust them at the next opportunity to transact, not continuously. What happened over this weekend is that a large number of institutional allocators simultaneously concluded that the risk environment had changed fundamentally enough to warrant a meaningful increase in their gold allocation. They could not act on Friday because the events happened after markets closed, so they acted at the first available opportunity, the Monday open. And when a large number of large allocators all try to buy the same asset at the same time, the price moves, not by $15 or $20, but by $200. That $200 move is the price of admission to the new risk regime. It is not a panic spike that will immediately reverse. Some portion of it may come back as the initial shock settles and the market gets more information about whether the conflict is escalating or de-escalating. But the structural floor has moved. The baseline from which gold now operates is higher than where it was on Friday afternoon. This is the distinction that most retail investors struggle to make in the immediate aftermath of a large move. They see gold up $200 and they think they missed it. They worry that buying at $200 above Friday's close means they are chasing. That concern is valid for a temporary spike driven by short-term positioning. It is less valid for a structural repricing driven by a genuine change in the risk environment. The question worth asking is not whether gold went up too fast. The question is whether the events that caused the move are temporary or structural. And that question does not yet have a definitive answer, which is why the analysts who describe gold and silver as set for an initial surge, then possible pullback, are being appropriately honest. The surge is the structural repricing. The possible pullback is the partial release of the event-specific premium, as the market gets clarity on whether the worst-case scenarios are materializing. The most important macro implication of this week's developments is not the gold move. It is the oil move and what oil at or near $100 per barrel means for the global economy and for Federal Reserve policy. Let's trace the logic carefully because this chain of cause and effect is where the most consequential investment implications live. Oil at $100 per barrel is not just an energy story, it is an inflation story. Oil is an input cost for virtually every sector of the modern economy. Transportation costs go up, manufacturing costs go up, agricultural costs go up because farming runs on fuel, heating and cooling costs go up. The full range of goods that need to be moved from where they are produced to where they are consumed becomes more expensive. All of that feeds through into consumer prices. It creates inflation that is not driven by excessive demand or by monetary policy failure. It is driven by a supply shock. And supply shock inflation is the hardest kind for a central bank to deal with because the standard tool, raising interest rates, does not fix a supply problem. Raising rates reduces demand, which can reduce some inflationary pressure, but it cannot put more oil into the market. It cannot reopen supply chains that are disrupted by conflict. It cannot undo the price effects of a regional war in one of the world's most energy-rich areas. Now add the Federal Reserve to this picture. The Fed was already in a difficult position before this week's events. The January minutes showed officials cautious on rate cuts and leaving hikes on the table. The Fed was managing an inflation picture that had proven stickier than expected and a labor market that remained resilient. In that environment, the Fed had already signaled it wanted more evidence of cooling inflation before making any moves. Oil near $100 gives the Fed more inflation, not less. It gives them a specific and credible upward pressure on consumer prices. That is going to show up in the CPI and PPI data in the coming months, and it gives them that inflation through a channel they cannot address with interest rates. This creates what economists call a stagflation scenario. Stagnating or slowing economic growth, because high oil prices slow consumer spending and business investment, combined with persistent or rising inflation. That is the scenario that central banks fear most because their tools are designed to address either excessive growth and inflation or insufficient growth and deflation. They are not designed to address both simultaneously. In a stagflation environment, gold and silver have historically performed well. The logic is straightforward. If the economy is slowing, risky assets like stocks underperform. If inflation is rising, bonds underperform because the fixed coupons they pay become worth less in real terms. That leaves hard assets, gold, silver, and to some extent commodities, as the assets that preserve purchasing power without requiring economic growth. This is why the potential for oil at $100 per barrel is one of the most significant numbers in this week's story. It is not just an energy headline. It is a signal about the macro environment that financial markets are now having to price. And the market's response, gold up substantially, stocks down, yields declining, is consistent with what you would expect if serious money believes stagflation risks are rising. The dollar's behavior this week deserves specific and careful attention because it appears contradictory on the surface, and the contradiction is actually very informative. The dollar strengthened as a safe haven. The dollar index was also volatile and described as having dipped before recovering. Gold also rose substantially. In a typical risk-off scenario, you might expect the dollar to rise and gold to fall slightly, or gold to rise and the dollar to stay flat. Having both the dollar and gold rise substantially at the same time is unusual and meaningful. When gold and the dollar rise together, it is telling you that the market is not making a straightforward currency call. It is not saying the dollar is strong because the US economy is outperforming. It is saying that all paper currencies are facing questions, and gold is the asset that has no currency denomination risk at all. Think about what this week's events mean for currencies broadly. The euro faces economic pressure from high oil prices given Europe's energy dependency. Emerging market currencies face pressure from a stronger dollar and from oil price sensitivity. The yen faces its own structural pressures. In an environment where every paper currency is facing some form of stress, the dollar wins the relative safety contest, while simultaneously losing ground to gold in the absolute safety contest. The dollar is the best house in a neighborhood where all the houses have problems. Gold is the house that exists outside the neighborhood entirely. Both can rise at the same time in that framework because they are appealing to different types of risk avoidance. The dollar's volatility, described as volatile with a post-dip recovery, reflects this tension. The short-term safe haven bid is pushing the dollar up, but the medium-term fiscal implications of an extended military engagement are pushing the dollar down. These competing forces are creating the volatility, and the resolution of that tension will depend on how the conflict develops. If it stays contained and resolves within Trump's stated 4-week framework, the fiscal pressure on the dollar is limited, and the safe haven bid likely dominates. If it extends beyond 4 weeks and expands geographically, the fiscal pressure grows, and the dollar faces more sustained headwinds even as the safe haven bid persists. Silver sits in an interesting position relative to this dollar dynamic. Silver is priced in dollars. When the dollar strengthens, silver faces the same mechanical headwind that gold faces. It costs more dollars to buy the same ounce. But the geopolitical safe haven demand for silver is strong enough in the current environment to overcome that headwind in the short term, just as it is for gold. The result is silver following gold higher despite dollar strength, which reinforces the conclusion that the demand driving both metals right now is not primarily currency-driven. It is risk-driven. There is one fact from this week. It's developments that financial coverage tends to address briefly and move past. 3 U.S. service members were killed in Iran's retaliation. 9 people were killed in an Israeli city strike. These are human tragedies, first and foremost, but they also carry specific financial market implications that deserve honest analysis. When U.S. service members are killed in a military engagement, it changes the political calculus around that engagement in ways that financial markets have to account for. Public and congressional support for a conflict has historically been sensitive to casualty levels. At the same time, casualties on the U.S. side can also create pressure to escalate rather than de-escalate, to respond to losses with additional force rather than with restraint. The financial market implication of casualties is that they increase the probability of a longer and more intense conflict. A conflict that began as a targeted strike to force a nuclear deal becomes harder to exit quickly when service members have been killed and domestic political pressures around those deaths are building. The 4-week timeline that Trump described becomes more difficult to hold to when each week brings additional casualties and additional political pressure. Markets are pricing this escalation risk. The 4 to 7% oil move reflects not just the supply disruption fear for today, but the compounding supply disruption risk over an extended period. The gold move reflects not just the immediate safe haven demand, but the elevated probability that the demand will need to be sustained over weeks rather than days. This is also why analysts described a potential initial surge, then possible pullback pattern for gold and silver. The initial surge captures the full probability distribution of outcomes, including the most severe escalation scenarios. As the conflict develops and some of those scenarios become less likely, if, for example, the conflict stays geographically contained even as it extends in time, some of that premium comes out. But the baseline, the structural floor under gold, stays elevated because the fundamental uncertainty stays elevated regardless of whether the worst-case scenarios materialize. Without making predictions about this specific conflict, it is worth understanding the general historical patterns of how extended Middle East conflicts have affected financial markets, because those patterns inform the range of reasonable expectations for how the current situation might develop. The general pattern across previous major Middle East conflicts involving oil supply risk looks like this. In the immediate phase, the first week or two, all of the reflexive safe haven moves happen simultaneously. Gold surges, oil surges, yields fall, stocks decline. This is the pricing of maximum uncertainty. In the intermediate phase, weeks 2 through 6 or 8, the market begins to differentiate. If the conflict stays geographically contained and oil supply chains prove more resilient than feared, oil prices partially stabilize or pull back from their highs. Some of the equity losses are recovered as the worst economic scenarios look less likely. Gold holds a significant portion of its gains, but gives back some of the initial spike premium. In the extended phase, beyond 2 months, the market response becomes much more dependent on whether oil supply has been genuinely disrupted. If supply flows are maintained, the economic impact is manageable and markets normalize relatively quickly once the conflict ends or stabilizes. If supply flows are genuinely disrupted, if oil stays at or near $100 for an extended period, the inflation effects begin to show up in the economic data, and the stagflation scenario starts to dominate market behavior. In that scenario, gold and silver tend to perform significantly better than either stocks or bonds over the extended time frame. The critical variable that determines which of these paths plays out is not the military outcome. It is the oil supply outcome. Whether the Strait of Hormuz remains open and functional. Whether the Gulf, states that host critical energy infrastructure, remain able to operate normally. Whether the conflict stays between the primary parties or expands to include regional actors whose involvement would more directly threaten oil supply chains. Right now, markets are pricing the uncertainty about which path plays out rather than confidence in any specific outcome. That is the appropriate response given the information available, and it is why you see such wide ranges in the numbers being discussed. Oil plus 4 to 7% in the near term with $100 as a scenario, gold up $200 at the open with a possible pullback mentioned in the same breath. If you currently hold physical gold or gold and silver mining stocks, this week's developments have almost certainly moved your position meaningfully higher. The relevant question is not whether to celebrate that. The relevant question, the honest framework is this. Your position is now carrying both a structural component and a geopolitical premium component. The structural component, the part built on central bank demand, on inflation concerns, on fiscal trajectory worries, on the long-term case for hard assets, was already there before this week's events. It is durable. It does not disappear when the geopolitical situation clarifies. The geopolitical premium component, the additional price that reflects the specific uncertainty created by this week's military escalation, is variable. It will fluctuate with the news flow. If the conflict moves toward resolution faster than the market currently expects, some of this premium will come out. If it escalates beyond current expectations, more premium will come in. That is the nature of event-driven price moves. The question each investor needs to answer for themselves is what their position size reflects and what their time horizon is. If you sized your gold and silver position based on the structural case, and the position has now grown larger than that original thesis justified because of the geopolitical premium, it is worth thinking about whether the current size is appropriate for your risk tolerance over your intended time horizon. That is not a recommendation to sell. It is a prompt to be deliberate rather than passive about what you are holding and why. For investors who do not currently own precious metals and are looking at a $200 gap up in gold thinking they missed it, the answer is more nuanced than either yes, you missed it, or no, the move is just starting. What you missed is the maximum expression of the initial shock. What still exists is the structural case that was in place before the shock. Whether today's price, which includes both the structural floor and the geopolitical premium, represents good value depends on your view of how both the conflict and the broader monetary environment develop. That is a judgment only you can make with your own information and your own risk tolerance. Closing thought. Gold is set to open $200 higher. Oil is up between 4 and 7%. Stocks are falling. The dollar strengthened. Treasury yields declined. 3 U.S. service members lost their lives. And President Trump has stated the conflict could last 4 more weeks. The conflict could last 4 more weeks. All of that happened between Friday afternoon and Monday morning. The $200 gap in gold is the market's summary verdict on what those events mean. It is not a prediction of where gold goes next week. It is a repricing of where gold belongs right now, given what just changed in the global risk environment. Here is the cautious, forward-looking observation that this moment deserves. 4 weeks is a timeline. Timelines in active military conflicts are statements of intent, not guarantees of outcome. The variables that will determine whether this conflict resolves within Trump's stated framework or extends beyond it are not fully within anyone's control. Iran's succession dynamics after the loss of its supreme leader, the degree of Hezbollah's continued involvement, whether Gulf state infrastructure remains operational, whether oil supply chains stay functional or face genuine disruption. None of those variables are settled. And here is the specific thing worth watching in the coming days: the oil price. Not because oil is the most important asset in this story. It is not. Gold is making the more significant structural statement. But oil's behavior over the next 2 to 3 weeks will determine whether the stagflation scenario that is currently being modeled by serious analysts becomes a real economic force or remains a tail risk that gets priced out as the situation stabilizes. If oil stays elevated toward or above $100, the inflation implications for Fed policy become impossible to ignore. The Fed's already hawkish stance faces a new source of inflationary pressure that it cannot address with its standard tools. And in that environment, the case for gold and silver as inflation hedges in a slowing economy becomes stronger, not weaker, as the weeks progress. If oil pulls back from current levels, as the immediate supply disruption fears prove overstated, the stagflation scenario loses some of its force, the geopolitical premium in gold partially releases, and the market moves into a more conventional risk-off holding pattern while waiting for resolution. Both outcomes are possible. The facts as they stand today support concern rather than confidence about which path plays out. And a market that opened $200 higher in gold before the first trade of the week is telling you that the serious money shares that concern. The $200 number is not a ceiling. It is not a floor. It is a verdict on the present. The future depends on what happens next in a conflict that, by the U.S. administration's own admission, has at least 4 more weeks to run. Watch the oil price, watch the geographic spread of the conflict, and watch what the bond market does with yields in the coming sessions. Those 3 variables, taken together, will tell you more about where gold and silver go from here than any single headline from the conflict zone.